Hi, I'm Patu from freefincal, and in this video, let's take a portfolio rebalancing example and see how it's done. Um, uh, I have done portfolio rebalancing. I've discussed it many times, but some people wanted me to take an example. I'm not sure why there's a need for an example because it's pretty simple, but well, that's what some people wanted. So I thought I will do it if it can be of some help. So before we begin, a couple of things. I've uh, I've recently become active again on Quora. When Quora started, I was active for some time, and then I kind of dropped out. But I've recently become active on it. So if you want to follow me on Quora and have a look at my answers, you can go ahead. The link is in the description box. My Quora profile is in the description box. Go ahead. Also, we are just days away from the counting date and days away from a new government. So everybody is getting jittery. The market participants are getting jittery. What's going to happen, and so on. So if you have questions about that, or if you have questions on any aspect of portfolio management, go ahead and ask them in the comment section, and I will take care of that in the coming days if I can. Also, if you have any specific problems on investing, not about which fund to buy and so on, but if you have specific problems, you can always ask, and if it's an interesting question that will be useful to everybody, I'll make it into a full video just like I did this. So what you see here in the Excel sheet is an imaginary portfolio of 40 lakhs. The total value of the portfolio is 40 lakhs. Out of this 40 lakhs, 24 lakhs 80,000 rupees is in equity. It is spread among 4 equity funds. So this 24 lakhs 80,000. That's the difference. There are 4 equity funds. 6.42 lakhs is in one fund, 2.15 lakhs is in another, 6.78 lakhs in another, 9.43 lakhs in another. Those are the weights. That's 25% weight here, 8% weight here, 27 and 34%. And these are the annualized returns or the XIRR as on date. So whenever you want to do a portfolio review, you must have these numbers before you, like that, in tabular form. Otherwise, it's very difficult for you to do it. So out of 40 lakhs, 24.8 is in equity. The remaining is in fixed income. 11.2 lakhs is in PPF. Then there is about a 4 lakh in arbitrage. In an arbitrage fund. Arbitrage, they are equity funds in terms of taxation, but in terms of risk, they are fixed income or debt fund like. So you can treat them as part of the debt fund. You can use it for rebalancing. I talked about this in my previous rebalancing videos. So the approximate PPF XIRR is 8%. It fluctuates, but over the years, if it's a reasonably old account, it will be about 8%. The arbitrage XIRR are as on date is about 6.6%. All these numbers are purely imaginary. I've just made this up for constructing. I just made this up for this particular example. So now, if you look at this, this 24.8 lakhs is 62% of the total value. That is, total value is 40 lakhs. Out of this, the equity is 62%. That's the current asset allocation. 62% is in equity. Then the remaining 38% is in fixed income, in arbitrage and PPF. So the thing is, what is rebalancing? Rebalancing is, to rebalance, first of all, you must have your desired asset allocation in mind. So you must say, for my portfolio, for this year in investment, I must have, let's say, 60% in equity and 40% in fixed income. The target asset allocation is 60% equity and 40% fixed income. This target asset allocation will change as the years go by, because as you go near the goal, you should decrease equity in a stepwise, gradual manner. So for this year, let's say the target is 60% equity and 40% fixed income. So it's quite trivial. That's the reason why I did not make this video. So before, it's quite trivial. So you have 62% equity. You have to remove 2% from equity and push it into your fixed income. You can put it into arbitrage, because if you want to rebalance it back, it will help. So Where will you remove it? So how much should you remove? The ideal equity asset allocation is 24 lakhs. That is 60% of 40 lakhs is 24 lakhs. The current asset allocation is the current allocation is 24 lakh 80,000. It should be 24 lakhs. So obviously you should remove 80,000. Where will you remove it from? Have a look at these four funds. I would suggest you remove the money, you remove 80,000 from this 2 lakh 15,000 because this fund already has got the lowest weight. It has got only 8% weight. If you keep reducing it on subsequent rebalancing, you can declutter your portfolio gradually. And also, if in terms of return, also there's not much difference between the. Sometimes what I do is, if a fund has got performed poorly, sometimes I will remove it. Sometimes if a fund has performed spectacularly high, then I will remove some money out of it. You can play any way you want, but the weights usually are what I usually look at. So if the weight is one fund is lower weight, so you can reduce it even further. So you push towards a 3 fund portfolio from a 4 fund portfolio. So what are the steps in rebalancing? First of all, have a target asset allocation, that is 60-40, 60% equity. Next, find out your current asset allocation, 62% equity. Find out how much you should remove. So you have to remove 80,000 out. Then find out where you have to remove that 80,000. You have found out you have to remove it from this 8.69% weighted fund. So from this 2.15 lakh, make a redemption for 80,000. Then once you remove that 80,000, it will come to your bank account after 3 days. So once it comes to your bank account, where will you invest it back? Immediately once it comes to your bank account, immediately push that 80,000 into this arbitrage fund. So that the asset allocation is rebalanced to 60-40. You are pushing it into arbitrage, not PPF, because to next year, if there is a market slump and that from 60-40 equity has become 55% and fixed income has become 45%, you will take 5% from this arbitrage and push it back into equity, and so on. So you can rebalance it back and forth is a balancing act, and that's essentially it. So the message I want to convey is, if you want to do a rebalancing or a portfolio review per se, even without rebalancing, you must have this kind of a table and this kind of information in one place, and then you make a call. And whatever you do, whether you are booking profit from equity or pushing money into equity, it should not only minimize risk in your portfolio by rebalancing, by resetting the asset allocation, it should also make your portfolio trimmer and more minimalist. That's essentially it. So if you have any questions on this and if you have any doubts, go ahead and leave a comment, and if I can answer them, I will try to, and I'll catch you all in another video. Thank you as always for watching. Bye bye.